Welcome to our Gabelli School Centennial Speaker Series webinar. Thank you for joining us for today's event featuring Michael Mauboussin talking to us about his book, Expectations Investing, Reading Stock Prices for Better Returns. My name is Srish Chatterjee, Professor of Finance and Business Economics at the Gabelli School and Gabelli Chair in Global Security Analysis, and it's my pleasure to be here on behalf of the Gabelli School. The Gabelli School Centennial Virtual Speaker Series began in 2020, marking 100 years of purpose-driven business education at Fordham. In the last year, the Gabelli Center for Global Security Analysis and our wonderful partners, the Museum of American Finance and CFA Society in New York, have sponsored more than 30 events that drew nearly 5,000 attendees. We are tremendously proud of this dynamic partnership, and a full archive of our video content will be shared in the thank you email you will receive. At the Gabelli School, a network of industry partners and global thought leaders empowers our community with the vision and values to use business as a catalyst for change. As guests, you are an important part of that work. Please enjoy our brand new lineup this year and help us share the word by inviting others in your network. Today's session features Michael Mauboussin, Head of Consilient Research at Counterpoint Global, Morgan Stanley Investment Management. He is an adjunct professor of finance at Columbia Business School. And in just a moment, I will hand this off to David Cowen, President and CEO of the Museum of American Finance, who will give Michael a proper introduction. Following today's discussion, David and I will facilitate audience questions, which we would ask that you type into the Q&A section near the bottom of your Zoom screen. Our speakers will be addressing as many of them as possible during the session. I also want to share that copies of Expectations Investing will be raffled off to attendees. Before I turn it over to David, I want to warmly ask that you consider making a donation to the Museum of American Finance or a gift to the Gabelli School Centennial Fund. You can make a tax-exempt gift quickly and securely online at the link provided in the chat. And now, without further ado, I turn it over to David.
Thanks, Srish, and it's great to be back with our friends at Fordham and the CFA Society. As Srish just mentioned, our author wears many accomplished hats at once, not just as mentioned, head of research at Counterpoint Global, which is an active fundamental equity team at Morgan Stanley, mentioned also that he is an adjunct professor at Columbia Business School, but also he is an author with many books and articles to his credit published in places like the FT and Harvard Business Review. And on top of that, you can follow Michael as he tweets. His handle is at MJ Mauboussin. Now, fittingly, he's been awarded the Graham and Dodd Murray Greenwald Prize for Value Investing, which is conferred by Columbia Business School in conjunction with the Gabelli Funds. And lastly of notice, he is chair emeritus of the Santa Fe Institute, which is an independent nonprofit think tank. Now, Expectations Investing is a fresh update of the author's first release almost 2 decades ago to now incorporate some recent megatrends like indexing, changes in accounting rules, and the shift to private equity. As soon as you start reading this book, your attention is grabbed by the preface because it's written by none other than Aswath Damodaran, the NYU professor known as the Dean of Valuations, a former speaker in this series. And Damodaran relays, why didn't he think of writing this book? The subtitle is Reading Stock Prices for Better Returns. Well, Michael, we are ready to learn how. It's my pleasure to turn it over to Michael Mauboussin.
Thank you very much, David. And it's really wonderful to be with everyone. So let me start today with, I guess, a bit of a professional epiphany that I had many years ago, which creates an arc to where we are today. I was a liberal arts major in college. I went to Wall Street. This is in the mid 1980s, and found myself awash in sort of old wives' tales and rules of thumb and so forth. And I found myself very confused. And right around that time, one of the colleagues in my program handed me a copy of Al Rappaport's book called Creating Shareholder Value. And that for me was the professional epiphany. And there were 3 points that Rappaport made, which have remained the cornerstone of everything I think about. The first is it's not about accounting numbers, but cash. And we'll talk about the implications for that in just a few moments, but it seems to be a lesson that we like to relearn from time to time. The second is that competitive strategy analysis and valuation have to be joined at the hip. And I think interestingly, in most schools, including Columbia Business Schools, we tend to teach those two things separately. We tend to teach finance over here and strategy over there, but really when you're an investor, you're operating at the intersection. In other words, you can't do valuation without understanding the competitive position of a company and the litmus test for quality strategies that it creates value. And then the third lesson was in chapter 7. The original chapter was called Stock Market Signals for Managers. And it basically said, hey, if you're an executive, you have to understand what's priced into your stock in order for you to make judicious capital allocations. And of course, that's a very obvious, useful tool for investors as well. So I first met Al Rappaport in May of 1991. It was an amazing, 30 years ago, it was a great meeting. And obviously I was really thrilled to meet with him. And then our relationship developed to the point where we decided to write the original version of Expectations Investing. Now, just to set the table here, we signed the contract for the book in the late 1990s when the market was roaring and investors were all excited. And the book came out on, just take this in for a second, September 10th, 2001. So a day before a national tragedy in the midst of a 3-year bear market. So the timing couldn't have been worse. So in recent years, as David mentioned, with all the developments that have happened in markets, we decided to do a revised and updated version of the book. So I'd like to do really 4 things today, tell you again what the big idea is, talk a bit about what drives value, and you'll see that we'll spend some time talking about one of the, I think, very significant developments in the last 20 or 30 years. Third, talk about why doesn't everybody do this if it makes so much sense, and then finally, how do you actually implement the process? And we'll do that fairly quickly. So what's the big idea? The big idea is expectations are really important. We've all had an experience along the following lines. So, you're talking to a friend or you're having dinner and they say, hey, I just watched this new series on TV. It's the greatest thing I've ever seen. You got to drop what you're doing and check it out. And so you build up your anticipation, you turn on the series and you watch it and you enjoy it, but you're not blown away by it, right? In the sense that you feel a little bit disappointed, right? So the universal equation I always like to say is satisfaction equals results minus expectations. And if your expectations get very lifted, sometimes you're not quite as satisfied as you would like. So I think the point is that expectations, like lots of things in life, does rely on expectations. Revisions in expectations, almost a tautological statement, but revisions cause stock prices to change. And then the key task for us as investors, as fundamental investors, is to anticipate those revisions and expectations. So the questions immediately become expectations about what? Like, what do we care about? Second, are all expectation revisions the same or some more important than others? And then finally, what's the best way to go about that task? So let me answer those questions right up front, and then we'll do a little bit more of a deep dive. We think expectations are appropriately based on the company's long-term cash flows. So again, very fundamentally driven, at the core very much of value investing. Second, expectations revisions are absolutely not the same. Some are much more important than others. And we'll talk in a few moments a bit about how to figure out what is most important when we're thinking about business value. And then third, as I've already alluded to, investors need to combine competitive strategy and finance to intelligently anticipate important revisions. So it's not one or the other, but really a combination of the two. Now, as I was thinking about the newer version of the book, I was thinking now, how has the world changed in the 20 years since we published this? So we did a now versus then. We did it at the end of August. So this is just a few months ago for the 2021 numbers. And we started with the top 10 companies in the US by market capitalization. Again, 2001 versus 2021. The first thing you note is only one company made both lists, and that happened to be Microsoft. But if you dwell on the right-hand side for just a few moments, you realize that 4 of the 10 companies on that list weren't public in 2001 And in fact, 2 of the 10 companies didn't even exist. They weren't yet founded. So, 20 years is not, it's a pretty long time, but it's not forever. And you could see really, really substantial watershed changes. Here's another interesting thing, talk about how expectations have shifted. If you look at the 2001 side, so now dwelling on the left, they added about $1.5 trillion in value in the aggregate, but that's mostly because of Microsoft, which is more than 100% of that sum. Excluding Microsoft, this group of 9 other companies lost $460 billion. And these are absolute dollars. And in fact, if their market capitalizations had simply kept up with the S&P 500, those other 9 companies would be worth $6.7 trillion more than they were. So you can see they lost enormous amounts of ground, relatively speaking, enormous revisions in expectations. Likewise, on the right-hand side, the value creation over the last 20 years was staggering. Apple's market cap at August 31st, 2001 was $7 billion. At this measure, it was about $2.5 trillion. Microsoft was $300 billion. Now it's almost $2 trillion. And then, of course, Amazon went from 7 billion to now 1.6 or 1.7 trillion dollars. So enormous wealth changes over time. The other reflection, and we'll talk about this in some more detail in just a few moments, but as a teaser, take a look at how companies invest and how that's changed over the last 20 years. So in 2001, you see intangible investments, which were recorded largely on the income statement, and CapEx were basically at the same level. So call it $640 billion. Fast forward to 2021, our estimate is that intangible investments will be about 2.1 trillion, which is more than double those of CapEx. So again, within, call it roughly 1 generation, a radical change in how companies are investing in their businesses. And again, the accountants are a little bit behind on keeping up with this. The third thing I'll point out, and this is really outside of expectations investing, it's more exogenous, but noteworthy nonetheless, is the discount rates. And David mentioned Aswath the motor, and so you can see down below, I cited Aswath on this. Here's Aswath's estimate of the cost of equity capital. So back in 2001, that number was 8.5%. And today, his August 31st reading or September 1st reading was 6%. So you see a 250 basis points reduction. Why that's important is that means the baseline price earnings multiple for the market back in the day was probably around 12 times. And the baseline, which is just one divided by the discount rate, is now more like 17 times. But what's also interesting is unpacking this, because if you look at this, what's happened is, by the way, credit spreads are down. So in other words, you're getting less spread today in credit than you did back in 2001. But what you see is the driver of this decline in equity risk and equity returns, expected returns, is really the risk-free rate. And you can see the equity risk premium by Aswath's reckoning is actually even higher. So this suggests, all things being equal, the returns for equities are more attractive than those of debt. Now, here's the last thing I'll say, which is interesting. That 6% is nominal, right? And so historically, equities have returned something like 6 to 7% real after adjustments for inflation. The most recent inflation expectation on the 10-year break even are something like 2.5, something like that. So now the market's looking at something like 3.5 to 4.5% real equity returns, vastly more muted than what we've enjoyed historically, but again, very consistent with other asset classes, including credit. So let me turn to the second section and talk about what drives value, and go back to the building blocks of business. As I grew up in central New York, my father, a small town, my father was a car dealer. And so I learned at his feet that what really drove value for a small business was the cash in versus the cash out. So when you're thinking about the value of a business, really, there are 3 questions you have to ask. How much money am I going to get? When am I getting my money? And how certain is it that I'm going to get it? And so basically, it's the cash flows, the risk, and the forecast horizon. Now, interestingly, of course, in credit, bonds, and real estate, some of these things are often contractual. So there's an actual contract between the 2 parties. For equities, of course, these are all based on expectations. And that's what makes our job really interesting. Now, to drill down for just a moment, to be a little bit more nerdy, what we care about is this concept called free cash flow. We're going to go from right to left on the page. Free cash flow is the pool of cash available for distribution to all the claim holders of the business. Classically defined, it's net operating profit after taxes minus investments, earnings minus investment, And NOPAT in turn is a function of sales, margins, and taxes. And investment classically is working capital changes, CapEx, net of depreciation, and then any sort of M&A activity. There are 2 points I want to make on this slide that I think are really important. One is the business community, and I think to some degree the financial community, still remain very income statement centric, right? We're still at the tail end of earnings season now. If you turn on CNBC after the close today, you'll see some earnings numbers tumble out. And what's going to come across the headline will be a sales growth rate and an earnings number, sometimes a mention of margins, but basically that's where it starts and stops. But of course, as an investor, if you understand the magnitude of investment and you have a sense of the return on investment, you will have a better crystal ball to understand future earnings and profitability of the business. The second point, which is related to the first, is that the global economy continues to shift from one based on tangible investments to one based on intangible investments. The accountants simply have not kept up. So as a consequence, investments are increasingly showing up on the income statement, not on the balance sheet. And that's just, it's conflating these items, earnings and investments, and making it a little bit more analytically challenging. So let's do a little bit of a discussion about this concept of intangibles. These are aggregate data. I mentioned, by the way, I started in the industry in the mid-1980s. So you can see even in my career, there's been a watershed change. But go back to 1977, you can see that tangible investments are roughly double those of intangible investments. And we're measuring these, by the way, as a percentage of gross value added, which is essentially kind of similar to gross domestic product. Now, fast forward to today, the last formal data we have is 2017, but you see the intangible tangible ratio is essentially flipped. By the way, for those who are like finance nerds, I'll mention one interesting thing, right, which is the Fama French 3-factor paper came out in the early 1990s, where they argued, right, that the CAPM was understating returns for low risk companies and introducing other factors would better represent the economic returns, and including price to book is one of those. And it was precisely at that point of crossover, right, which is really interesting. So their data were going obviously backward in a very different world. And when you look forward, you can see why price to book may have lost some of its relevance. Now, here's probably the money slide of the whole discussion today, which is what's happened to intangible investments. So let me take one little step back and say what the academics have done here is taken, so cost of goods sold, we're going to assume is associated with revenues in that period, so that's fine. And then we're going to take SG&A. And then the question becomes, for SG&A, what component of it is maintenance? In other words, the money we need to spend just to keep the trains running on time and to deliver the mail. And then what is incremental as an investment? So intangible investments, right? That's really what we're trying to do here. And so here's an estimate of that breakdown over time. To give you some sort of a level set for 2020, intangible investments, we estimate were $1.8 trillion, whereas CapEx was about $900 billion. So tangible investments double CapEx in the year 2020. And you could see maintenance CapEx was also about 800 billion or something like that. Of the intangible investments, by the way, R&D was about 450 billion. So that's about a quarter of the total intangible investments, which is really interesting, right? So people go, oh yeah, I got the intangibles in my calculation because I capitalize R&D. If that's the case, you're only capturing what is a relatively small percentage of the whole thing. So to me, this is an incredibly important development, and analytically, as a security analyst, something that's really important and quite exciting, candidly, because if you have a better beat on it, you're going to do a better job than other people. Now, I want to make this very concrete and drill down on a specific example, and that's from Microsoft. And I want to show you kind of the before and after adjustment numbers to give you some sense of the importance of this. So here's Microsoft's free cash flow. This is the very classic definition. So if you take a finance course or read a book on this, this is how you're going to do it. And you could see that your earnings are, there's a little bit of rounding here, but basically your NOPAT comes out to $62 billion. Your investment's $20 billion, so 62 minus 20 gives you $42 billion of free cash flow. Again, the pool of cash available for distribution to all the claim holders, right? So this is your standard finance definition. By the way, I'll just mention one thing as a side note, is that when people talk about free cash flow on Wall Street or even corporations, they often use a very different definition than what I'm showing here, right? They often, what they usually say is cash flow from operations minus CapEx. And you'll note that that's a very different calculation than what we have here. This is the proper calculation if you're doing a cash flow based model. Okay, so now what we want to do is reflect the intangible investments and capitalize them on the balance sheet. And if you're doing that, there are two big decisions you have to make. The first is what percent of various items of SG&A should be allocated to intangible investments. And the second big decision is what is an appropriate amortization period? What is the useful life of those particular investments? Now, for this, I cheated a little bit. I deferred to the work of Chuck Holton, who's a big guy in this field at the University of Maryland, who actually wrote a paper about Microsoft. You can see cited down below. So I'm going to punt a little bit and just say, here are the Holton numbers. So you can see he assumes that 100% of R&D is an intangible investment. By the way, I think that number is too high. I would use something lower than that, probably something like 75%, but that's fine. 70% of sales and marketing and 20%. And then for the amortization periods, he selected 6 years for R&D. That's a little bit long for me. I think probably 5 years is a better number. And then 2 years for sales and marketing and G&A. But this is the basic Holton framework that gives you some sense. Now, note that their total SG&A was $46 billion. And what we're saying here is that of that, $36 billion in investment, right? So this is vastly bigger than their CapEx. So sometimes people say Microsoft's sort of a capital light business, but no, not really if you think about investments in this context. And now here's the before and after for the intangible investment. So again, these are the numbers I've already shown you: 62 billion of NOPAT, $20 billion of investment, the $42 billion of free cash flow. But now we make the adjustments. We're adding back the intangible investment. We created an amortization schedule to amortize the past intangibles. So what we're going to do is end up adding $7 billion to the earnings of the company, and we're going to add the same $7 billion to the investment. So you see that earnings go up, whatever that comes out to, 10, 15%. Investments go up 30, 35%, something like that. And again, free cash flow is unperturbed, right? Because that's the cash in versus cash out. But you can see the path to getting there is very, very different. And I think analytically very important for us to all understand. We could do the very similar analysis for their balance sheet to understand return on invested capital. So on the left is the classic definition. And you can see their invested capital is about $120 billion. And their ROIC, 62 over the average, is 58%. So it's spectacular, right? But if you make all these adjustments, what you see is their invested capital goes from 120 billion to over $200 billion. So about an 80% increase. And you can see that their ROIC goes from 58%, which is again, spectacular, otherworldly, to 37%. So still very, very high, but much more muted, right? Okay, so if this is such a good idea, and David mentioned Aswath saying like, why didn't I think of that? Why doesn't everybody do this, right? So interestingly, Warren Buffett has said a number of times that to really understand investing, you only have to read 3 chapters of books. The first is chapter 8 from The Intelligent Investor. And chapter 8, if you recall or read the book, is about the metaphor of Mr. Market, right? So this defines your attitude about markets. The second is chapter 20, which is about the concept of margin of safety. And we're going to reintroduce that in just a few moments, but again, margin of safety. And then the third chapter he recommends is chapter 12 from Keynes' General Theory, which is called The State of Long-Term Expectation, which, by the way, is a beautiful chapter, and it's sort of behavioral finance before behavioral finance became popular. And he's got just one little sentence in there, which is, and he says, the actual results of investment over a long term of years very seldom agree with the initial expectation. And that is precisely the concept that we're trying to capture in this type of work. In mid-September, I did a guest lecture at Columbia Business School for a colleague of mine. And along the way, I did a survey of the students. And I said, how many of you have heard of John Burr Williams? And I was struck by the fact that absolutely none of them had ever heard of John Burr Williams. And I would just say, if you're a student or certainly a professional, John Burr Williams is someone whose work you should be familiar with. And in 1938, he wrote one of the really important books on valuation called The Theory of Investment Value, where he basically laid out for the first time a dividend discount model or a dividend cash flow model. By the way, Warren Buffett referred to John Burr Williams in his 1992 annual report. So that popularized it to some degree 30 years ago, but still doesn't seem to have really gotten out there as much as it can. So, Williams writes this book. And then what I love is chapter 15 of this book was called A Chapter for Skeptics. And I would just say today, there are lots of people who are skeptical of discounted cash flow models because, I just changed the assumptions a little bit and it changed the value a lot and so on and so forth. And so John Burr Williams takes this on head on, and he says, he asks and answer questions like, are these formulas too intricate? Are these formulas too long-term oriented? Are these formulas too impractical? Are these data or is this approach corroborated by experience? And I want to just draw out what John Burr Williams said in this chapter. He says, those who feel it unsound to use long-range forecasts may still use the new formulas another way. They may use the actual market price as a datum and then may deduce the growth that is implied by the actual market price and see whether the prevailing price is reasonable or not. So in a nutshell, John Burr Williams in 1938 captured a lot of what we were talking about with expectation investing, again, using kind of older and more clunky language, but basically the same idea. One of the most powerful metaphors for expectations investing is actually horse handicapping. So if you're a handicapper trying to bet on horse races, you need to think about two things. One is how fast the horse is going to run. Let's call that fundamentals. And the second is what the tote board says about the prospects for that horse. Let's call that expectations. So making money is really about fundamentals versus expectations. Now, I teach security analysis at Columbia Business School. And on the first day of class, I assign a bunch of readings. A lot of it's classic Ben Graham stuff to get people very grounded and rooted. But I also include a 13-page chapter called Christ on Value, written by a guy named Stephen Christ. By the way, Christ himself is a very interesting guy, very colorful guy. I won't go through his history, but I would just say that Christ on Value, which if you Google it, you'll find it, is one of the best 13 pages written about investing that I've ever read. And so what I'd like to do is actually read to you just this paragraph. Obviously, we'll focus on what is bolded. But as I do that, please take out the word horse and insert the word stock and see if it's that different than our actual experience. So he says the issue is not which horse in the race is the most likely winner, but which horse or horses are offering odds that exceed their actual chance of victory. And this next line is really important. He says, this may sound elementary and many players think they're following this principle, but few actually do. And I think that's true for expectations investing as well. Under this mindset, everything but the odds fades from view. There is no such thing as liking a horse to win a race, only an attractive discrepancy between his chances and his price. Only attractive discrepancy between fundamentals and expectations. And I think that really does capture what we're after here. Michael Steinhardt was also a very famous hedge fund manager about 20 years ago. He wrote his memoirs and he used this term he called variant perception. We use that term a lot as well in the investment industry. And basically the key is what is distinguishing between what's priced in and what the fundamentals are likely to be. So he says, I define variant perception as holding a well-founded view that was meaningfully different from the market consensus. Understanding market expectation was at least as important as and often different from the fundamental knowledge. Again, reiterating that basic point. Again, why do people not do this? I think the most common approach by far is to estimate value by using multiples or some sort of a model. Now, there was a survey of just under 2,000 CFA charter holders, and they asked them how they valued businesses. And the vast majority, more than 90%, said they used multiples. The two most popular multiples, number one was price to earnings. Number two was enterprise value to EBITDA. Again, multiples are fine, but they're shorthands for the valuation process, and people should be very careful about understanding what is implied by multiples. In my class, I say you have to earn the right to use a multiple, and you do that by showing that you know what the multiple implies about the economic performance of the business. Second is a lot of investors are wary of discounted cash flow models. I've already pointed that out. In some ways, we're sidestepping that problem, but I find it very ironic that people don't like DCF models and are very comfortable with multiples, even though in the DCF model, all your assumptions are explicit. And in a multiple, all your assumptions are implicit and unpacked. So you actually you're winging it, and you're actually using a much, much blunter and less debatable instrument. And then finally, most don't use available tools, the expectations infrastructure, which I'll share for you in just a moment, and the application of base rates, which we know from the decision-making literature is incredibly valuable. So here's the last section. How do I implement this expectation investing process? I'll go through this very quickly. I'm not going to bore you with all the details. There are really three steps in the process. Number one, and you're going to follow this very intuitively. One is estimate price implied expectations. Second is figure out where the opportunities lie. And then third, make your buy and sell decisions. So how do you figure out price implied expectations? Well, we're going to use a discounted cash flow model because we know that that's how economics basically work. We're not going to forecast our own views, right? We're going to basically do our best to understand and use the consensus to guide what we think the market believes. Now, I want to be clear, there's some art in this. It's not pure science, but you can get a sense of what has to happen for this particular stock price to make sense. What's good is now we're avoiding the shortcomings of traditional valuation multiples. Again, we're laying bare our assumptions about growth and profitability and investments and so forth. And then the last thing I'll just say is I would try to be agnostic. So when you're doing step one is don't bring your baggage to the situation. Just try to figure out what has to happen for this to make sense. And don't worry about whether it is reasonable or not just yet. Now, if you want another metaphor for this, I would say the metaphor is how high has the bar been set for the high jumper, right? You don't really care how high the jumper can jump just now. You just want to know where the bar is set, broadly speaking. Step two is understanding the expectations, opportunities. The first place to start is obviously history. History can be informative in terms of trends and growth rates and so forth. Talk about strategy analysis, and I'll mention that in just a moment. And then finally, determine which trigger matters the most. Let me just slow down for a moment. There are two really helpful heuristics. And by the way, for students, this is super powerful, but even for practitioners, they sometimes don't get this as fast as they should. Here's the basic heuristic. If you have a value creating business, that business is going to be very sensitive to incremental growth, right? High returns on capital, very sensitive to incremental growth. So you're going to focus a lot on changes in growth rates. By contrast, if you have a value neutral business, it's going to be essentially insensitive to growth, but it's going to be very sensitive to incremental returns. So right away, you know where you're going to place your emphasis between these two things specifically. Now, before you leave this section, what we like to do is to understand scenarios for the most important value trigger, and that's usually sales. And so think about how good could the world be, how bad could the world be, and something in between. Strategy analysis, I won't go through this, but you can see we follow basically a funnel. We start with what we call the lay of the land. So we think about things like the industry map, value pools, market share tests to figure out stability, think about external forces. I didn't put it here, but I myself love to look at entry and exit data. So to find out who's coming in, who's going out. Next, we drop down to industry assessment. So understand things like the 5 forces and value chains. And then disruptive innovation, value chains below, disruptive innovation, so the Clay Christensen work. And then finally, source of firm-specific competitive advantage. And that's really disassembling value chains to compare and contrast various companies. Let me just say, as a broad comment, that strategy analysis is ultimately about identifying trade-offs. And so if you understand strategy, you understand the trade-offs that particular company has made. Now, I'm going to give you another rule of thumb, especially, again, good for students and certainly practitioners, which is thinking about a differentiation versus a low-cost producer. So one of the things you can do that's very convenient is take a return on invested capital calculation and decompose that into a simplified DuPont formula. Basically look at margins versus capital velocity, right? So let me be a little more specific. Margins would be NOPAT divided by sales, right? So how much you make per unit. And then capital velocity would be sales divided by invested capital, right? So if you multiply those two things, of course, the sales will cancel out and the product is NOPAT over invested capital, which is ROIC, right? So we have two components, and you can think about getting to the same ROIC either through high margins and low velocity or low margins and high velocity. And here's the basic guide is if you have a high margin, low velocity business, that is a differentiation strategy generically. And then you can pull out the differentiation strategy checklist and start to think through the items. By contrast, if it's low margin, high capital velocity, you have a low cost producer. And here again, you can pull out the checklist for low cost producers. So this, I think, is a very robust way to think about this. Now there's, I'll tell you one very quick story on Rappaport 9, how this expectations infrastructure was born. The original book we mapped out, there were 16 original chapters. The book only has 12 now, but we had 16 originally. Rappaport had a competitive advantage in all of them, right? Because he's a seasoned academic and very smart and had done a lot of great work. And I was many years his junior. but we try to think about comparative advantage, right? So where could I kind of hold my own? And so we broke the book into two sections of 8, and we started working on those. And one of the chapters I was working on was this idea, we laid it out, of finding businesses that we called sales-driven businesses. And then next, I was going to write a chapter about margin-driven businesses. And then finally, a chapter about investment-driven businesses. And it seemed to be very sensible. And I actually wrote the sales-driven business, and that seemed to come out pretty well. And I was pretty pleased with the outcome. And then I turned my attention to margin-driven businesses. And immediately I found myself in trouble. And the reason was that the margins go up and down, with a causal factor for margins going up and down was almost always because sales were going up and down. So there was a fundamental interactivity between sales and margins that simple approach did not take into consideration. And by the way, I'll say that much sensitivity analysis that I see from both investment analysts and consultants and even companies fails to reflect this. So we went back to the drawing board and created what we call the expectations infrastructure, which I think is a very, very powerful tool. And we start with 3 value triggers: sales, costs, and investments. Every business everywhere has these 3 things. But then we run them through what we call value factors, right? Because those are too blunt to map to the value drivers. The value factors for those related to sales, volume, price, and mix, those are fairly self-explanatory. Operating leverage and economies of scale. And operating leverage and economies of scale, of course, are distinct concepts. They're often conflated and used interchangeably, but they're different. Operating leverage means that you're absorbing pre-production costs. So you build a factory that can manufacture 100 widgets. You're starting off at 50 widgets, and as you go from 50 to 100, you're enjoying operating leverage. You're leveraging pre-production costs. And economies of scale simply says we can do things cheaper as we get bigger. So big is better. For example, negotiate with your suppliers more effectively and so forth. Cost efficiencies then are going to be independent of sales, so taking out costs, and then finally investment and investment efficiencies. So before you leave this analysis, what you want to do again is go back to your ranges of, so you want to figure out, first of all, which is the most important value trigger. It's almost always sales, by the way, you can see. And then say, let me think about thoughtful scenarios for sales. And by the way, again, here's where you can leverage things like base rates to help you inform. And then you're going to come up with scenarios after running through those sales growth rates through the value factors, scenarios for value and ultimate value for the business. So you're going to leave this section with potential outcomes and scenarios, and you're going to assign probabilities to those. So that is the key. And then that leads to the final step, which is making buy and sell decisions. With outcomes and probabilities, you now have an expected value. What you want to do then is buy the stock when it's below expected value and sell it when it's above expected value, and do nothing when it's in between. So margin of safety, we're going to now define as the gap between expected value and price. And then for your excess returns, you're going to think about things like time to close the gap. And of course, in doing all your calculations, we want to take into consideration costs and taxes. The other thing I'll just say, which we sort of layer on top, is throughout, you want to manage or mitigate the types of decision errors that we all tend to make. So we need to think about those in our process. Now, for our case study in the book, we selected Domino's Pizza. By the way, they just reported earnings today. It's a beautiful, fantastic business. The last version of the book, we picked Gateway 2000. I don't know how many people remember that company, but unfortunately it perished a few years after we actually wrote that book. I'm hopeful that Domino's will be around for some time to come. But Domino's, again, a really interesting and nice business to model. And then just to finish on a couple other thoughts, we have a couple other chapters dedicated to what I think are important, and they were important 20 years ago, but they're even more important today. The first is this idea, we called the chapter Beyond Discounted Cash Flow, is the idea of real options. And real options, I don't want to overstate this or hyperventilate, but real options can be very important, especially when four conditions are met. Number one is uncertain markets. So generally speaking, uncertainty means higher discount rates, which means lower present values. But of course, if you're long an option, uncertainty or volatility actually tends to be enhancing of value. Second is capable management. By that, I mean managements that can identify, nurture, and ultimately exercise options intelligently. Market leaders tend to be helpful because they tend to get the first call on certain things. And then access to capital is really important. I think post the dot-com bust, by the way, there was a lot of potential for option value, but a lot of that was muted because there was no access to capital. So great options without access to capital doesn't really lead to much. Now, in the first version of the book, we used as our case study for the real options, Amazon.com, which ended up being quite prescient, probably more lucky than prescient, actually. In the new version, we use Shopify, which also seems to meet these criteria quite nicely. And then the other thing we talk about is reflexivity. And, it's interesting that I think most of us think about value as somewhat independent of stock price. And we think that we observe the value and the stock price should match up with it. And we don't really think about how the stock price itself could affect fundamentals. George Soros introduced this idea of reflexivity. It's been around for a long time, but it's a feedback concept, which basically says the stock price and the fundamentals can be interact with one another. Probably the poster child for now of this now is Tesla, where as the story got more whipped up, it allowed them to access more capital and to give them a longer runway for their performance and so on and so forth. But even to some degree, things like the meme stocks would fit this as well. Chapter 9, we call Across the Economic Landscape. And I also think this is very important. Basically what we do, and even more important today than ever before. So we basically say, here are 3 really simple categories of businesses, of very simple taxonomy. Physical is the advantage source is assets. So think about, restaurants or retail. You need physical stores to do that. Service means that people now are the source of competitive advantage, but people deliver the service one-on-one. So this would be your accountant or your lawyer or your barber or something like that. And then knowledge is actually people remain at the core of competitive advantage, but they create content once and they replicate it many times. So think about a recording artist or a software engineer writing code and so forth, right? So as you imagine, the investment triggers are different. For the first 2, physical and services, capacity, right? So if your factory runs out of capacity, you need to add more capacity to meet demand. If you're running a law firm and you want to do more business, you need to hire more lawyers. Within the capacity of within their productivity. But of course, for knowledge, it actually the marginal cost is essentially 0. So your risk there is obsolescence. And so you get different versions of scale economies and different degrees of scalability for each of these businesses. And I'll just mention even more traditional businesses. So Deere, for example, have been trying to migrate their businesses from one that was predominantly based on physical one to one based on knowledge. And then we have a couple chapters that touch on capital allocation, which can be very important for an investor and for revisions and expectations. One chapter on mergers and acquisitions. One of the punchlines there is that many of the metrics that investors and investment bankers use, for example, earnings accretion, are a very poor way of thinking about value creation for M&A. We tend to prefer to think about basically an NPV calculation, which is the difference between the synergy and the premium. And then we also have a chapter on share buybacks. I find buybacks to be baffling because people seem to not understand them very well. But we talk about the trends in payout policies, and we lay out what we call the golden rule of share buybacks. And then finally talk about some companies that indeed have what we call impure motives. Let me finish there. I'll just mention 2 other things. One is we have a website that accompanies the book. It's free. So it's just expectationsinvesting.com. And I would welcome you to join. So there are some background on the book and chapter summaries and so on and so forth. And then the key thing, and especially for students, but even to some degree practitioners, we have online tutorials. And so what each of these tutorials, and there are 10 of them, each of them explain a concept. And in most instances, there is an Excel spreadsheet that you can click and download. So for example, if you go to price implied expectations, which is tutorial 8, you'll see the Domino's case study, which is in the book. You'll see the exact spreadsheet that supported it. So if you want to reverse engineer all the numbers, you'll be able to do that. And more importantly, especially if a practitioner, you will then be able to use that model and tailor it for your own purposes. Or M&A, I use the M&A module number 9. I use it all the time still. A new deal gets announced, you read it in the Wall Street Journal, you jot down a couple facts, punch the numbers into the M&A module, and it will actually predict the cumulative abnormal returns for both the buyer and the seller, right, on the spot. So then you can check to see how accurate that is. So with that, I will stop. And I think we have 15 minutes or so, and love to hear questions, comments, corrections, all the above.
Michael, that was an excellent tour de force through a lot of things. You touched upon so many important ideas and topics and concepts. Very hard for me to figure out where to start from. So let me start with something you mentioned at the very beginning, and you also referred to towards the end, which has to do with corporate strategy and finance. And I think that is such an important statement you make, that there is a deep connection between the two. And in strategy, we are always thinking about keeping our options open. So a company thinks about strategy. It's about the possibility that 5 years down the road, they may or may not do something. They want to retain the option. And of course, towards the end, you talked about real options and how that could perhaps be integrated with the standard free cash flow based DCF. But my question is not just about the real options component of corporate strategy, but also how intangible investment is linked to it. Perhaps a large part of intangible investment is targeted towards keeping those options open, or options that might open up in the future. So from your vast experience, would you like to say something about how we could augment the DCF with some of these real options and perhaps link to the intangible investment growth that we are seeing?
Yes, thank you. It's a wonderful question. By the way, I'd love to get your take on this, because you're also, you probably know more than I do about all this stuff. I will say that I wrote a fair bit about real options in the late 1990s and early 2000s. And I'd be curious if your experience is the same. I think that people find the concepts very intuitively appealing, but the actual application is quite tricky for both corporates and for investors as well. I think the applications are easier in things like extraction industry. So you have a well where, if $60 oil makes sense, but $40 oil doesn't. So, you have an option. It's easy to value that option because you have volatility, you have market-based numbers and so on and so forth. Trickier to do for companies. But you're exactly right. I mean, we dedicated a chapter to this exact topic because we felt that DCF, even back in the day, but certainly today, that DCF can fail to capture these options, as you correctly describe, as these strategic opportunities that companies want to keep open. So what we try to do in the book is to back into it and just say, and again, I don't want to come across as saying, waving a wand and saying everything is a real option and you should pay whatever you want, right? We want to maintain our discipline. But in the chapter, and by the way, one of the tutorials is on real options, and we actually have, we have frameworks to help you do this. What we basically say is, okay, the stock price is at X. I'm going to look at the businesses I can touch and feel and project today, and it's going to give me some value. And then if there's a value above and beyond that, I'm not going to say automatically it's overvalued. I'm going to say, let me say that I believe that the market's attributing that to real option value. And then we're going to go backward, precisely as you just described. We're going to go backward and say, what do we have to believe for that real option to be worth what the market implies that it's worth, right? So then we're going to just go through a traditional option pricing model. By the way, we tend to not place long values on these things. So a Black-Scholes model is going to work fine, or a simple binomial model is going to work fine. So go 2 or 3 years out. We don't want to go out 10 years for these kinds of things. And figure out, how big would the projects have to be, how much would we have to invest, and so forth for them to make sense. So I think that ruling out real options or not acknowledging them is problematic. But I think by the same token, you don't want to get too excited. Now, the other thing I'll just say is that, now Jeff Bezos has stepped down from Amazon.com. So all this stuff is easy to say in retrospect. But I think one of the greatest skills of Bezos was capital allocation. And I think he was one of these guys that really was good at identifying and nurturing real options. And I think, you could argue that AWS itself, by the way, was the mother of all great real options that he identified and exercised, and hence created a lot of value. So not all managers are great at it. I'll just say that. And then the other thing I'll say is that even when we wrote the original version of the book and I wrote some research about real options, I was approached by a bunch of companies that had businesses that were kind of boring and they were not very volatile. They make, pet food or something like that. And so when the volatility is relatively low, right, the option value is not going to be that great. So this is going to apply mostly in these sort of more blue sky where we really don't know what the ranges of outcomes. And again, we have these sort of asymmetric payouts. So I don't know if that's a satisfactory answer to your really excellent question, but that's what we talked about in the chapter and how to think about that and flesh it out and how to, again, reverse engineer what you have to believe about the option value to make it make sense.
No, thank you. That was great. Let me turn it over to David, who may have some questions.
Thanks, Michael. We've got a couple, but the first, a quick one. What were the 13 pages again? The audience would like to know that you could please.
Yeah, so it's called Christ on Value, and it's from a book called Bet with the Best. I want you guys to be impressed because I'm pulling this off my shelf. So it's a book called Bet Can you see that? Bet with the best. And so it's chapter from there called Christ on Value. But I'm pretty sure that if you Google it, there is a version of it floating around out there, and it is chapter 3, page 61 in this book.
Great. The next one is the audience like to know, how do you read stock prices like GameStop for better returns?
Yeah, I think that's a really, so let me just take one step back. If I can go beyond expectations investing, and the work that we do tends to go in one of 4 areas. One is markets. I mean, David, you mentioned even in the introduction, sort of, what's happening with private equity and active to passive and in net investing and so on and so forth. So we think a lot about markets and market efficiency. We think about valuation, we think about strategy, and then we think about decision-making. So those are the 4 building blocks. So the interesting question is, what is going on with these meme stocks? By the way, for those who study market history, there have been episodes not dissimilar to this many times in history. So perhaps there's a Robinhood, generator, the fact that people are sitting around at home with nothing to do during COVID, that sort of spark. But the basic idea of individuals getting excited about particular things have been around for a very long time. So I think that those are examples of market inefficiencies. Those companies do not seem to have fundamentals that would substantiate their current valuations. Now, the flip side is, if I want to temper that argument, I would temper it with the reflexivity argument, right? Which is AMC's gone up, or Tesla's gone up, or GameStop has gone up. All those companies have issued equity, right? They sold stock, and so they're smart. So that means that the value of the business actually, if you're selling overvalued equity, it means the per share value goes up for those who hold. So in a sense, they actually could have mathematically created value just by selling overvalued stock. So it's a really interesting world. One of the things that I would always encourage people to do is to try to maintain discipline, right, in all these kinds of environments. So for me, and by the way, GameStop was actually, had a year ago, before all this stuff got going, there was a legitimate, fundamental case for it, right? There was change in management and so on and so forth, and the stock was on its back. So that my answer would be there are pockets of inefficiencies. And the other thing about market inefficiencies that are really important is that in the financial lingo, we call it arbitrage cost, right? So it's one thing to see an inefficiency. It's another thing to be able to take advantage of it. And sometimes the costs to taking advantage of things are prohibitively high. So obviously it's a bunch of hedge funds try to short GameStop and they got carried out and so forth. So it's not just, I know that this is overvalued or this is mispriced, but the question is, what are the costs to actually closing that gap between price and value? And that's a whole nother consideration in trying to get to markets to market efficiency.
We have an audience question here. This is from Carl Bume. Carl is asking, speaking of exogenous events, presently the energy sector has the lowest sector weight in the history of S&P 500, about 2.5%. Can it be argued that ubiquitous ESG mandate screens interfere and distort time-honored value investing principles? Free cash flow estimates for the top 5 super majors will report about a combined $29 billion in free cash flow in the third quarter, according to analyst estimate compiled by Bloomberg. That would be the most since the beginning of 2008. Is this significant alpha opportunity in your view?
Yeah, well, it's a leading. There's a lead. Talk about leading the witness, right? I think these are tricky ones, right? So it is. I think it's, and I'm not spent a lot of time on this, and I'm sure there are people who are more informed than I am. So I just want to be clear that I'll say that with all those caveats. I think at least the first wave, it's not true for all, but I think the first wave of ESG investing has tended to exclude versus change, right? So in other words, we say here are 500 companies in the S&P 500, which do not meet our criteria, whatever, and we're going to get rid of those. And as a consequence, those things can be sold. Now, what that effectively means is the opportunity cost of capital goes up, right? And as a consequence, the returns would go higher. So, I mean, alpha really, of course, is risk-adjusted returns. So you might get higher returns than you used to get, but there may not be alpha, right? So to me, that's an interesting one. And I've not looked at this, but one of the ways I'd want to test that would be to look at the credit. For example, look at the bonds, right? Where ESG, whether ESG has been affected there as much, and just see what happened with credit spreads and see if the whole complex seems to make sense. So now, again, it's interesting that if you take long sweeps, we've done a lot of work on capital allocation over the years. So how companies spend money, M&A, CapEx, R&D, and so on and so forth. And interesting, a lot of our data sets started in 1980. And what's really interesting is that energy and industrials were a very substantial percentage of the market capitalization back then, right? Because of the period we had just been through. So just to be really clear about all this stuff is that industries and sectors ebb and flow in terms of their significance. And it's very difficult to remain as the king of the hill for a very long time, right? And so as you recall, just from that slide I showed, the number one company by market capitalization in 2001 was GE. And it was considered to be a juggernaut, right? Recall, they dominated the world. They had this, the best management training programs and so on and so forth. So yeah, I don't know. I have no comment about the particular sector and the valuations, but I think that the ESG comment's really worthy of a lot of consideration. And is it just reflecting a higher cost of capital, or is there something else more fundamental?
The audience would like to know if these investment approaches work well in all global markets.
Yeah, so we make that claim. I mean, in other words, the concept, the fundamental concept is so basic, which is that, and it's not just equities, by the way, it's any asset price, right? That has a stream of cash flows. Forget about things that are art or cryptocurrency, whatever, but things with streams of cash flows, it should absolutely work everywhere, right? Absolutely.
David, do we have time for one or two more?
Of course.
Okay, so here's another audience question from Terry Lally. The far right tail today has similarities to 1999. Reverse engineering expectations implies aggressive growth in sales and profitability and the valuation of call options. Tesla is a good example. Aswath Damodaran's valuation of Tesla is dramatically lower than market price and participants like ARK. Your thoughts?
Yeah, I mean, I've got no comment. I'm not going to talk about any specific companies, but it's hard to disagree. We've analyzed Tesla in our class many times over the last 10 years, and I think that's the conclusion people often come up with. But once again, what I would encourage people to do is to figure out what has to happen for the stock price to make sense, and whether there are other assets like data that may be more valuable than people think versus just manufacturing automobiles. But yeah, no, I think that's it's hard for me to disagree with that observation. And even a guy I used to work with just posted something about Tesla today. So yeah, I mean, it's not the kind of thing where I would say it's certainly not a low expectation situation, put it that way.
Stephanie would like to know, with ESG stocks having performed well lately, do you think ESG is a spurious correlation? Is it just that well-positioned companies are better poised to meet ESG criteria? Also, what are criteria that are meaningful in evaluating ESGs?
I mean, this is we could spend hours and hours on just this topic, right? And I suspect you guys maybe are having a session on this. We actually take all the sustainability research very seriously at Counterpoint Global and think a lot about it. What we really try to think about are there opportunities for things that are more win-win than anything else, right? So how do we understand, and by the way, here's the other thing I'll just say, which is really important, is that somehow people think that creating shareholder value is about delivering short-term earnings and stock price performance and so forth. But what shareholder value is about is building long-term cash flows. And I think, to state the obvious, I think that taking care of your community and your environment and doing things in the best way possible are really important to that long-term story. So these are not inconsistent with what I think is ultimately going to be good business. So I have very little to say about ESG. I think it's really important, but I would focus, rather than taking things out, I would just think, are there win-win opportunities?
So I want to thank you very much for a very illuminating hour. It was terrific. And just to mention that the series will continue on November 17th with the father of the futures market, former chair of the CME, Leo Melamed, in conversation with Bob Pisani. And our start time will be a little earlier at 11:30. I also wouldn't be remiss if I didn't mention that we will be having a SPAC event in December. And I'm sure, Michael, that in your lifetime, you will never invest in a SPAC. So once again, on behalf of our friends at Fordham and the CFA Society of New York, we extend our warmest gratitude and thank you to Michael Mauboussin. See you all soon.